11.
The entity's financial statements shall be prepared using uniform accounting policies for all transactions and events in similar circumstances. True, sir.
Okay, this is what I mentioned earlier. You will have to use uniform accounting policies. 11 is true.
Number 12. If an associate or a joint venture has outstanding cumulative preference shares that are held by parties other than the entity and are classified as equity, the entity computes its share of profit or loss after adjusting for the dividends on such shares when the dividends have been declared. False, sir.
What makes it false?
Um, when the dividends had been declared, it should be whether or not dividends have been declared.
So number 12 is false.
Number 13. If an entity's ownership interest in an associate or a joint venture is reduced, but the investment continues to be classified either as an associate or a joint venture, respectively, the entity shall reclassify to profit or loss the proportion of the gain or loss that had previously been recognized in other comprehensive income relating to that reduction in ownership interest if that gain or loss would be required to be reclassified to profit or loss on the disposal of the related assets or liabilities. True.
Okay, so this is true, class, but it's completely fine if you cannot visualize how this is actually going to be applied, class. This is not a concern for our subject yet. Okay, but just know that number 13 is true. Next.
14. The concepts underlying the procedures used in accounting for the acquisition of a subsidiary are not adopted in accounting for the acquisition of an investment in an associate or a joint venture. False. Because the concepts underlying the procedures used in accounting for the acquisition of a subsidiary are also adopted in accounting for the acquisition of an investment in an associate or a joint venture.
Okay, it's wrong to say that they are not adopted. So number 14 is false.
Number 1. It is an entity over which the investor has significant influence. Letter A, sir, associate. It was in the book, sir.
Okay, class, if you will get this kind of question wrong, class ba, this should be a giveaway question. Okay, I always want you to take advantage of this kind of question, class. Number 2.
Which statement is true concerning significant influence? A. If an investor holds directly or indirectly less than 20% of the voting power of the investee, it is presumed that the investor does not have significant influence unless such influence can be clearly demonstrated. B. If an investor holds directly or indirectly 20% or more of the voting power of the investee, it is presumed that the investor does have significant influence unless it can be clearly demonstrated that this is not the case. C. A substantial or majority ownership by another investor does not necessarily preclude an investor from having significant influence. D. All of these statements are true about significant influence. Our answer here, sir, is letter D.
Okay, that's correct. I think I've explained Alpha and Bravo already. For Charlie class, the point there is you already have more than 50% interest in the business. Normally, that makes you the majority shareholder. That makes the investee your subsidiary. But it's possible nga even though you have more than 50%, but you do not have control yet. All you have is significant influence. So it's entirely possible that you already have more than 50%, but you still just have significant influence. Normally, when you have majority of the shareholdings, we would say that you already have control, not just influence, but control. But again, it's possible that you have more than 50%, but all you have is influence and not full control over the investee corporation. Okay, next.
When an entity holds between 20% and 50% of the voting power of an investee, which statement is true? A. The investor must use equity method. B. The investor should use equity method unless circumstances indicate that it is unable to exercise significant influence over the investee. C. The investor must use fair value method unless it can be clearly demonstrated that the investor has significant influence over the investee, or D, the investor must use the fair value method. Our answer, sir, is B, since the standard requires the investor to apply the equity method.
Okay, that's correct. Bravo.
Number 4, an investor shall discontinue the equity method when
Our answer for number 4 is letter A. An investor shall discontinue the use of the equity method from the date when it ceases to have significant influence over an associate and shall account for the investment in accordance with IAS 39 from that date, provided the associate does not become a subsidiary or a joint venture as defined in IAS 31.
Okay? But it's PFRS 9 now, not past 39.